So our next topic is going to be the balance sheet, and I want to first focus on the purpose. We're using the balance sheet to find changes in fixed assets and changes in net working capital. The different capital budgeting models that we are going to use may or may not require a detailed balance sheet. So, for example, more detail would be needed if current assets and current liabilities are specific. Net working capital is current assets minus current liabilities. So if we're concerned about net working capital, then we might have to build a very detailed balance sheet to make sure that we can capture those current assets and current liabilities. But sometimes the working capital requirements are simply going to be given as a % of revenues. For example, revenues could, it'll say, the net working capital for the project is going to be 15% of revenues. In these situations, you can think of the current asset mainly being inventory. If it's given as a % of revenues, then less detail is going to be needed on our balance sheet. So I want to go make sure that we're capable of building the pro forma balance sheet. I think it's important, but keep in mind that for some problems, it might be a little bit overkill. Some of the homework problems, it might be a little bit overkill. When you're doing your capital budgeting project, I do believe you should have a very detailed balance sheet. All 3 financial statements should be there and be detailed. So we already talked a little bit about the current assets and liabilities in our exam in the previous slide, but basically current assets that a project might require are going to be cash, inventory, and accounts receivable. Liabilities that a project might have from current liabilities will be accounts payable. And net working capital is the difference between current assets and current liabilities. Why this matters will come in topic 3 as we talk more about cash flows, but from a pro forma balance sheet perspective, the idea here is this is what's going to go as our inputs. We can calculate the net working capital off of this balance sheet. When we talk about investment in long-term fixed assets, we really have 2 components that are important. So we need to track the capital expenditures that are associated with the project. This is typically going to occur at the beginning of the project. So Disney is going to build a new theme park. Most of the investment in long-term fixed assets is going to be occurring in year 0, if not all. So we basically will always be assuming that the investments in fixed assets occur in year 0. It is important to track on the balance sheet the depreciation that's going on and the book value of the asset. So you're going to have the cash component from the balance sheet, the investment in year 0, but also the book value of the asset over time as you continue to depreciate it down. This is important because we might have situations where you can salvage the fixed assets at the end of a project. So Disney might build a new theme park that's only going to last for 10 years. In the end of year 10, it can sell off some of those assets, and we need to know what is the book value so we can compute what we call an after-tax salvage value. So we take taxes into account when the project is completed. So this is the basic idea of the balance sheet. We are not going to be that focused on the right-hand side of the balance sheet when in terms of long-term liabilities and shareholders' equity, because it's not going to matter too much to our cash flows. So our main focus here is going to be on the current assets, the current liabilities, so the top left and top right side of the balance sheets, and the long-term fixed assets, left lower side of the balance sheet. The last statement, financial statement that we'll look at is the statement of cash flows in the next video.